Good day, everyone. I am Korin Silvosa, the first reporter for Chapter 6. For every credit, there is risk involved. Credit risk refers to the possibility of non-payment of the obligation when it falls due. Credit risk is a chance that a bond issuer will not make the coupon payments or principal repayment to its bondholders. Why does credit risk matter? Credit risk is one of the most fundamental types of risk. After all, it represents the chance the investor will lose his or her investment. It's important for lenders to manage their credit risk because if customers don't repay their credit, the lenders loses money. If this loss occurs on a large enough scale, it can affect the lender's cash flow. How do you manage credit risk? Credit risk management is an important function within any business because it enables the business to maximize sales while carefully managing its risk exposure. Improper credit risk management reduces the bank profitability, affects the quality of its assets, and increases loan losses and non-performing loan which may eventually lead to financial distress. Financial institutions attempt to mitigate the risk of lending to borrowers by performing a credit analysis on individuals and businesses applying for a new credit account or loan. This process is based on a review of five key factors that predict the probability of a borrower defaulting on his debt. Credit risks may be minimized by a careful examination of the C's of credit. The C's of credit are character, capacity, capital, collateral of the borrower, and the prevailing conditions surrounding the business. This is to decide whether a loan applicant is eligible for credit and to determine related interest rates and credit limits. They help determine the riskiness of a borrower. The first C is character. Character is the most comprehensive aspect of the evaluation of credit worthiness. The premise is that an individual's track record of managing credit and making payments indicates their character as relevant to the lender. Character measures how reliable and trustworthy you are. Lenders have a good reason to consider your character, and that is simply that they need to be able to know if you are going to pay them back. To determine a person's character, lenders look at the following: work experience, to confirm consistent income, references, past interactions with lenders, and credit history. Credit history will let lenders view your credit report and credit score for information. This information lets them know how long you have been in business, bankruptcies, whether make time payments or not, and more. Other evidences of character are the position held by an individual in business or in social organizations, and the stability of his employment and business connections. In general, the character of a small business or corporation reflects the character of the persons operating it. But in a big corporation or establishment, the case may be different in that its operations are governed by policies. The credit manager would therefore look into its management policies and facilities for record keeping, its paying record, statement of condition, etc. The second C is capacity. Capacity signifies the ability of a debtor to pay his obligation. A debtor may be willing to pay his debt, but may not have the cash with which to pay when it falls due. Lenders must be sure that the borrower has the ability to repay the loan based on the proposed amount and terms. Capacity is also referred to as cash flow and indicates their ability to repay the loan. When looking at an application, lenders look at the following factors: business debt, cash flow statements, credit score, bank statements, repayment history of previous loans.
Good day, Mamazing and classmates. I'm Roselle Mongaya. I'm going to report the three remaining C's in credit risk. The three remaining C's in credit risk: capital, collateral, and condition. Capital. Capital is the financial strength of a business. Lenders also consider any capital the borrower puts toward a potential investment. A large contribution by the borrower decreases the chance of default. Borrowers who can put a down payment on a home, for example, typically find it easier to receive a mortgage. Down payments indicate the borrower's level of seriousness, which can make lenders more comfortable extending credit. Down payment size can also affect the rates and terms of a borrower's loan. Generally speaking, larger down payments result in better rates and terms. With mortgage loans, for example, a down payment of 20% or more should help a borrower avoid the requirement to purchase additional private mortgage insurance. Another way to avoid credit risk is to require the borrower to put up some type of collateral. Collaterals are properties of value pledged to secure a loan. They may be personal or real properties. This includes financial and other resources such as bank deposits, inventories, receivables, and other assets that the company can pledge for loans. Collateral will help the creditors recoup the money that they have lent if the loan goes into default. For example, you could make a borrower give you his car if he is unable to repay the money that he has borrowed. Lastly, condition. Condition refers to the environment and the customer's industry, economically, legally, and politically in relation to growth. In addition to examining income, lenders look at the length of time an applicant has been employed at their current job and future job stability. The conditions of the loan, such as the interest rate and amount of principal, influence the lender's desire to finance the borrower. Conditions can refer to how a borrower intends to use the money. Consider a borrower who applies for a car loan or a home improvement loan. A lender may be more likely to approve those loans because of their specific purpose rather than a signature loan or character loan. A good faith.
Good day everyone, I'm Ailene Mae Valeriano and I'm going to discuss the hazards in the use of credit and credit information. What is credit risk? Credit risk is the risk of loss due to a borrower not repaying a loan. More specifically, it refers to a lender's risk of having its cash flows interrupted when a borrower does not pay principal or interest to it. Credit risk is considered to be higher when the borrower does not have sufficient cash flows or sufficient asset to liquidate to repay the creditor. If the risk of non-payment is higher, the lender is more likely to demand compensation in the form of a higher interest rate. Hazards in the use of credit. Improper use of credit on non-productive goods may encourage consumption without a corresponding increase in production and thus would result to inflation. Inflation is an economic term that refers on rising prices of goods and services within a particular economy. As general prices rise, the purchasing power of consumers decreases. The measure of inflation over time is referred to as a rate of inflation. Commonly, people may refer to inflation as the rising cost of living. Hazards of having a credit card. First, undisciplined use. Using credit for non-essential and not paying off the balance promptly. Second, bad credit. Maintaining a high debt-to-limit ratio and making late payments. Third, fraud. In the internet age, identity and card thieves still find a way to get your personal informations. Fourth, financial stress. Since there are dangers resulting from the abuse of credit, the monetary authorities should exercise utmost care in managing our credit system. Republic Act number 265 an act establishing the Central Bank of the Philippines, defining its power in the administration of the monetary and banking system, amending the pertinent provisions of the Administrative Code with respect to the currency and the Bureau of Banking, and for other purposes. The objectives of this act are to maintain monetary stability in the Philippines, to preserve the international value and convertibility of peso, and to promote rising level of production, employment, and real income of Philippines. That's all. Thank you.
I will be discussing about credit information. When we say credit information, it is the information about a person's or company's ability to pay debt, and it contains necessary information before they can lend money. It is important that the credit man should be able to gather information about his prospective debtors. They have to acquire every possible information they could get from their customer, because the more information they can have about them, the more reliable and secure their credit decision becomes. To gather information, it can be done either orally or in written form. And with the information acquired, it can help them to make the best informed decisions about customers' ability and willingness to meet obligations within credit terms. I will be discussing the sources of credit information. The first one is the application form. For me, this is the best and easier way to gather information, because you just have to give the form, normally ranges from single page to as many as 4 to 6 pages, and the creditor will just fill up the necessary information being asked on the form. In installment credit, a new applicant is oftentimes filed for every new purchase. There must be a person in charge to assess customers in case they don't know how or what to answer some questions being asked on the application form. The next one is personal interview. This is done with a direct contact with the customer to assess them personally. Usually, questions being asked during interview are the same with the questions on the application form. The advantage of personal interview is that you can ask the customer precisely what you want to know. The both of you can interact or converse freely and ask questions not found on the application form, but is also important for the both of you because personal interview is a two-way communication. And also, during personal interview, you can also persuade them. Kung baga, para sa atin is tinatawag nating sales talk, o sinisales talk natin sila. And during personal interview, the interviewer must show friendly attitude, because this will affect the whole mood of the interview and will influence the customer whether to be more open or share more about themselves. The credit manager should be in a position to offer good advice, which the customer most often seek. This is because mas nagiging comfortable or confident and feel secured sila if the credit manager or the person who conducted the interview satisfied them by giving the information that they wanted to know. Good personal relationship established between the debtor and the creditor at the start will stand in future dealings. And other cases, if nagustuhan ka ng customer, they can recommend you to others, and by that you can have a lot of customers, which is good for you. In conclusion, through application form, it is hassle-free to gather information because it is conducted non-verbally. You just have to assess them in case they have to clarify about something. But if you want to personally assess the customer, it is suggested that you go with a personal interview, because through this you can acquire a huge pool of information about the customer and witness their personality and establish friendly relationship with them.